Next token. Theta is a project that is looking to completely transform the way we think about streaming and online content delivery. More specifically, they want to decentralize and democratize it. And the Theta blockchain is the only end-to-end infrastructure for decentralized video streaming and delivery currently on the market. This type of scale is all possible thanks to some pretty mind-blowing streaming and blockchain technology. I won't go into it here because I can't do it service in the time allotted. However, I mainly want to get on to why I think Theta could be such a hot pick for next year. Firstly, streaming itself is really hot. You need look no further than YouTube and Twitch with billions of users. These are all on centralized platforms and use centralized content delivery networks, so you can see why Theta is appealing here. Secondly, this is not just pie in the sky. Theta is actually streaming content. They started with esports but have since moved on to poker, cryptocurrency events, and have also partnered with MGM to briefly stream Hollywood classics. Oh, you can also add the SpaceX launch and K-pop events to that list. I also want to note that Theta has a strong team and even stronger advisors. These include the likes of Stephen Chen, a YouTube founder, and Justin Kan, the founder of Twitch. Theta has also received investments from the likes of Samsung. I should also point out that in September, Theta Labs got a US patent for their decentralized blockchain streaming technology, formally titled, quote, Methods and Systems for a Decentralized Data Streaming and Delivery Network. As we all know, patents help secure business moats. When it comes to the tokenomics of Theta, there are two tokens here, Theta and TFUEL. Theta has a capped supply and all tokens are now in circulation. This means that you're not at risk of any dumps from investors or team members. Also, note that 55% of all the Theta tokens are being staked, which means less token supply on the market. When staking these Theta tokens, you'll earn TFUEL or TFUEL. TFUEL is used as gas for smart contracts and once used will be permanently destroyed. So not only can you own rare and limited Theta tokens as well as stake them, but you will also earn TFUEL tokens which should become more valuable over time as they're burnt, assuming protocol inflation doesn't outweigh it. Something else that you should note from a utility demand perspective is that Theta smart contracts will be compatible with Ethereum. This means that Theta could also bring in a bit of that hot DeFi flavor that Ethereum has been the recipient of this year. This utility demand could drive price. And there's one more thing waiting in the wings that could boost that Theta price. That is a potential Coinbase listing. In July of this year, the exchange placed Theta on their list of tokens that they are considering listing. And we all know the impact of the infamous Coinbase pump. So yes, I think Theta could be an attractive and diverse play for your 2021 portfolio. I now want to move on to my next pick, and this is a medium cap gem. The Injective Protocol is a decentralized derivatives exchange that's built on Cosmos. It was one of the most exciting DEX launches this year and has already picked up quite a bit of steam. Full disclosure, I hold some INJ in my personal portfolio and for good reason. They are trying to create a paradigm shift in the DEX space. Quite simply, it will allow users to trade spot, swaps, and futures in a completely permissionless way. They'll also be able to structure their own derivatives on the platform and create a market for it. Anything that has a price, users could eventually be able to issue their own decentralized derivative contracts for. Technically, it's implemented as a Cosmos SDK module and is built with Ethermint. This basically means it has one major advantage over most of the Ethereum-based DEXs on the market: throughput. This is because it's a layer 2 Cosmos zone and hence does not have to put up with the congestion that other Ethereum-based DEXs do. Moreover, because it's built on Cosmos, you can exchange more than just ERC20 assets. This basically comes down to the nature of how Cosmos zones operate. Instead of one singular blockchain, there are a number of independent and interoperable blockchains. I'm only just scratching the surface on the tech behind Injective, really. I encourage you to watch my full video on it if you want the full DL. That's in the top right. So clearly, I am bullish on the tech behind the Injective Protocol, but there are a number of other reasons why it's one to watch in 2021. Firstly, Injective Labs is backed by some pretty well-known VCs in the space. These include the likes of Pantera Capital and Binance. Secondly, the team is also quite accomplished, and they've actually been working on the protocol for quite some time, since 2018 in fact. More recently though, they have released their Solstice testnet, and it's looking just as hot as the summer solstice. The amount of community enthusiasm around this testnet launch was quite intense. It also attracted some media coverage with stories on the like of TechCrunch and Cointelegraph. Turns out that this was only the first salvo though, and the Injective team recently released a version 2 of their testnet, only 8 days after version 1 was released. Impressive stuff. If it all goes to plan on the testnet, then we're looking to a much hyped mainnet launch in 2021. When it comes to the INJ token itself, it actually has some pretty favourable tokenomics. There was only a limited percentage, only 9% of the total supply. There was such high demand for it in the IEO that the price immediately rallied once trading commenced. I also would not worry too much about any of those private sale or founder tokens flooding the market anytime soon. That's because the token unlock schedule appears to be quite reasonable, no cliffs over here. And once the mainnet does launch, these tokens will be used in order to pay transaction fees. These fees are then burned, which of course leads to a reduction in circulating supply. Add to that tokens taken off the market to stake on the network, and you have two factors which are long-term price positive. That's not even including the potential demand that there could be to hold the token to take part in decentralized governance. As we've seen from the DeFi space, the opportunity to take part in decentralized governance of the protocol is an important valuation metric in the token. Apart from all that though, INJ has a lot more upside potential than the first 3 picks, and that's because of its market cap. Higher return multiples are likely for smaller cap coins. And speaking of market cap, it's time to reveal my microcap moonshot pick of 2021. Barnbridge is a DeFi project that I covered a few months ago, and it really is a mind-blowing protocol. Basically, it's a project that's looking to tokenize risk. So, what do I mean by that? Well, they're trying to isolate and tokenize different yield risks in the DeFi space. Essentially, it works by pooling funds on the platform and then allocating these funds to different DeFi protocols. These include the likes of Aave, Compound, DYDX, Synthetics, etc. Then, once the funds have been pooled, they will tranche the yield such that it can be tokenized individually. This therefore means that DeFi investors are able to invest in different risk tranches based on their yield and risk tolerance. This is called their Smart Yield product, and it was the first one that they launched. However, they're also working on a similar product called Smart Alpha. This will be more complex and won't be based on tranching DeFi yield or interest, but by separating out token returns into different risk tranches. Essentially, risk exposure will come from price instead of yield. Now, I understand if this sounds a bit complicated. All you need to know, though, is that it's a completely unique project in the DeFi space. Not only is it matching users up with their desired risk tranches, but it will also allow users to invest in fixed interest rate DeFi instruments, certainty around that yield. So, why am I bullish on Barnbridge? Well, firstly, it's well positioned to take advantage of the massive shifts we're seeing in DeFi. The total value locked into DeFi protocols has gone parabolic this year, and I don't think it's likely to slow down next year. Given the unique nature of Barnbridge's protocol, it's likely to be that much more attractive than all the plain vanilla lending platforms and DEX protocols. Secondly, the project has also been backed by the founders of both Aave and Synthetics, who no doubt know a thing or two about growing a DeFi protocol. They only raised a minimal amount of initial seed funding and ran a pretty fair launch of the protocol. There was no ICO, and 68% of the bond token will be distributed to the community through a number of yield farming and liquidity incentives. These governance tokens will then be used in order to vote on important governance proposals on the platform. There are plans in the pipeline to eventually release smart contracts governed by the DAO, where users can define what they would like the core contracts to do. This will mean that the members of the Barnbridge community may have a say in how risk is tranched and which protocols to invest in. So, much like the case of Wi-Fi, where token holders make economic decisions which progresses the entire Yearn finance platform forward, bond token holders will be able to do the same. So this adds fundamental value to the token. Apart from that, we can also just look at the broader tokenomics. there will only ever be 10 million bond tokens distributed. Once they've been fully distributed in about 2 to 3 years, you won't be able to mine any more of it. Hence, you have an asset with a naturally limited supply. Think about Yearn Finance, for example. Once those 30,000 Wi-Fi tokens were distributed, they became pretty damn valuable. Moreover, the Barnbridge community seems to be quite engaged in the project, and 2 days after yield farming went live, there were already $200 million locked into the protocol. The devs are also hard at work building out those lending products, which are likely to go live within the next few months. If these products do truly live up to its expectations, I have a feeling that Barnbridge may be a DeFi darling of 2021. When it comes to those bond tokens, they are currently only available on Uniswap for trading. Although, if you have some free stablecoin capital, then you could also join their liquidity pools and farm some bond, all covered in my Barnbridge video. Given the currently low market cap of bond, the upside potential from here is quite substantial. I will of course caveat this all and say that it is still a new protocol, and as such there are risks. Higher risks than other projects I've covered. But that's life, isn't it? Risk versus reward.